Coming up on the SBS On the Money podcast, the ASX 200 nears a correction as Donald Trump implements a 25% import tariff on steel and aluminium products. And BlueScope responds. We'll tell you what it said next. Hi everyone, it's your daily 10-minute business and finance news wrap for this Wednesday, the 12th of March 2025. Another horrible day for the Australian share market. The S&P ASX 200 down 1.33%, 7,786, the lowest so far this year. And since the high in February, the market is now down 9%. A correction is a 10% decline from its recent peak. And it comes as BlueScope Steel, Australia's largest steel exporter, says it's disappointed the US will apply a 25% import tariff on steel and aluminium products, including for Australia. That's despite the company saying it has a presence in the US, employing more than 4,000 people and having invested $5 billion there. Still, BHP shares fell by 0.9% today. That's better than the ASX's 1.3% fall. For more, I spoke with Nick Schoenmaker from Drummond Capital Partners. Nick, so the market's really been hit hard again today as Donald Trump confirmed Australia would not be exempt from a 25% tariff on all steel and aluminium exports. But these exports only form 0.2% of Australia's total goods exports. So why this severe market reaction?
Yeah, I think, Ricardo, it's probably more of a confluence of things that have caused a bit of a risk-off tone emanating from matters overseas. So you've had investors start to question whether the Trump put exists. So Trump's made some comments in the media recently to suggest he's not watching the market. So I think that's one. I think investors are starting to question the narrative that a lot of Trump's rhetoric around tariffs were negotiation, not implementation, and now it seems there is more implementation, and also just broader geopolitical concerns with some of the very, I guess, erratic and uncertain nature of what's happening in global affairs.
The sell-off today is edging the ASX 200 closer to correction territory. Just how close are we? Are we headed that way? And how serious would that be?
Yeah, so I think we've actually technically had the 10% drawdown now. I think the S&P 500 is at about 9%. I think we've hit 10% correction territory today. We've had the NASDAQ well into correction territory, and the Magnificent Seven this year to date, have down over 20%. So one of the things, I guess, that exacerbates some of the momentum, whether it's up or down in markets now, is just a lot of the non-fundamentally driven investors like CTAs, for example, or volatility trading funds. So when you do have trends becoming more meaningful, whether it's a bull market or bear market trend, some of those quantitative actors in the market can exacerbate the trends. But also, having said that, as we've seen this year, when you have momentum one way, there can be a sharp inflection point and things can turn around quickly. So if there was something to appease investors' concerns about the erratic and uncertain nature of the Trump administration's policies, you could get quite a risk on tone. But I would suggest that in the shorter term, we've got quite a period of volatility ahead of us.
Okay, what about that medium to longer term session though? Because the US markets in particular, Donald Trump is planning a series of tax cuts, which is what a lot of investors were focusing on at the beginning when he was elected, right? He has implied that, yes, there's a bit of work to do before we see these benefits. How do you view US shares? Because at the same time, aren't European investors pulling money out of the US and spending it in the US and in Europe as well now too?
Yeah, so there's some really good points that you've made in there. I guess the Trump trades that we saw kind of really beginning after the Federal Reserve cut rates 50 basis points in September. We'd had that period where bond yields before that had been falling for a few months, and then bond yields started to push higher and bonds sold off leading up to Trump, and then post-Trump. There were some periods of quite strong performance in different months through that period where US small caps did very well. So a lot of these Trump trades have now kind of reversed, and we've seen through February a big rotation where ex-US has outperformed. So it's starting to have some parallels of that period before 2007, from about 2003 to 2007, where non-US exceptionalism existed, or the US underperformed other markets. So I think that rotation has a little bit of legs for now. We've had a few things that have rattled investors in the US this year. There's been the Chinese AI startup DeepSeek questioning the moat that US megacap tech had in AI, the tariff uncertainty. But on top of that, despite the fact that we've had some weak soft data, consumer sentiment has declined, corporate confidence has shown some weakness. There is some signs that US GDP nowcast data is softer. We still do have a robust labour market in the US. Unemployment is 4.1%. We still think corporate earnings in the US could broaden outside of mega cap tech. And longer term, I think just the democratization of AI and the broadening of its use can see quite a significant productivity boon in the US. But in the shorter term, a lot of the liquidity tailwinds that was being supported in the US, so very strong fiscal spend, the expectation for interest rate cuts, are now almost more tailwinds in China, where you have very strong stimulus, both fiscal and monetary. In Europe as well, you've got the ECB policy rate at about 2.5% now. That could get lower this year, and you've also got the expectation now of a massive fiscal spend. So I think in the shorter term, that rotation is likely to continue, but I think medium term, the US still looks quite good given strong corporate earnings and those other factors I mentioned.
We've spoken a fair bit today on tariffs, and earlier you also said there were some other geopolitical concerns to be mindful of, right? What are they exactly?
Yeah, so I guess trade policy is a really big one at the moment. Look, we've had hot conflicts now since 2022 in Russia and Ukraine. We have to see how things pan out there. There's talk about a ceasefire and so on. We've had a huge conflict that's been longer than many thought in the Middle East for now, and that's very hard to say how things will pan out there. Some of the dynamics between Saudi Arabia and Iran look like they were improving over the last couple of years. That doesn't seem to be the case now. So there's a lot going on globally. I guess some of the things related to the US that you need to keep an eye on is the US now under the Trump administration starting to move to more of a soft authoritarian regime that's more around countries like India, Brazil, Turkey, even Poland and Hungary would be examples of that. So that's longer term things, and that would be very material because democracies are better for capitalism, they're better for company earnings. So that's a big one to keep an eye on. Obviously now with what we've seen with Trump and Zelensky and just all the scrambling in Europe to kind of remilitarize, is the US totally withdrawing from NATO? What are the implications for that? And at the extreme ends again, what happens if the Ukraine military lost support? Could it collapse? Could Russia move, further to the doorsteps of broader Europe? So there's a lot going on geopolitically, and I think there's going to be, again, just that defence spending, and even in countries like Australia, obviously, there would ultimately perhaps be threats to sovereignty here, like other countries, if we don't have the same relationship with a key ally, the US, as we did in the past. So I think there is some big structural shifts going on, but it's hard to see how definitive those things play out in the shorter term.
And given all this volatility we're seeing at the moment, has it changed the way you're investing, and are there still opportunities for investors at the moment?
Yeah, so we reduced risk on the 25th of February. We made a tactical adjustment to our equity exposure. We were overweight growth exposure overall. We're neutral now, but we're underweight both Australian and global equities. We added just a little bit to global bonds. We have been very underweight global bonds for a long time. We do still think long-dated government bonds, whether it's in the US or Europe, will have upward pressure on yields given fiscal deficits, so that diversification benefits, while they've been promising through February and this month as yields have fell, are less reliable in the long term. So we're still a little bit cautious on government bonds, but very overweight domestic credit. We also added a little bit to kind of hedge fund diversifiers. when we de-risked, again, just to have some strategies that can target positive total returns without having to rely on that kind of directionality or market beta.
It's Nick Schoenmaker there from Drummond Capital Partners. Don't forget to give this podcast a rating or review on Apple Podcasts and Spotify, and to click subscribe. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.